Jerome Powell, the Fed's chairman, said at a press conference that the economy does not work for anyone without price stability. But raising interest rates, which is believed to be the central bank's strongest tool for controlling inflation, also means the cost of borrowing will rise. But this is not the only adverse effect it can have on the economy. For instance, it can totally kill consumer confidence, which can spiral into fewer jobs and lower wages, resulting in stock prices falling. But in the bid to control inflation, if the interest rate keeps rising, it will get to a point where it leads to economic recession. Knowing all of this, how then do the central banks aim to control inflation by raising interest rates? Early this November, the central bank said in a statement that job gains have been robust in recent months, yet unemployment rate has remained low. The central bank reported that inflation has remained elevated, which reflects supply and demand imbalances. Now, let's remember that the financial aim of lending someone money is to gain more money, right? This more money, which is your profit, is gotten through the interest rate placed on the amount being borrowed. In the same way, if you're the person borrowing money, there is also an interest rate placed on the amount you're borrowing. Now, instead of lending money to another person, let's say you're lending it to a bank in the form of savings. A high interest on your savings means more money for you, right? And the thing about these interest rates is that there is no specific rate that is used by all commercial banks. Nevertheless, all of these rates set by different banks are influenced by the central bank's interest rate. For those who do not already know, a central bank is a bank where other banks go to keep their money. So it's like a bank for banks. So, just as how you earn by interest when you save money in your local bank, commercial banks also earn interest when they keep their money in a central bank. Normally, commercial banks have extra money, something like cash on hand, which is formally known as extra reserves. What they do with this is they lend the extra reserves amongst themselves at certain interest rates and make money for themselves. They can also decide to put this extra reserve in a central bank and earn money via interest rate. The day-to-day consumer does not get a cut from this interest rate, you see, but they're definitely affected by it. That's the goal right there. By raising their interest rates, central banks are trying to control inflation. The Federal Reserve or the Bank of England, BOE, or the European Central Bank are all aiming for the 2% inflation mark. And they're fully aware that they can most likely meet their target by manipulating the interest rate. Now here's how the trick goes. When the Federal Reserve, or the Bank of England, or any central bank for that matter, raises their interest rate, the commercial banks in that country will have no option other than to do the same, which will cause them to earn more on their reserves. Also, they earn by putting their money in the central bank, which is now offering a higher interest rate. Now, this rise in interest rate is bound to affect consumers. Take mortgages, for instance. Let's say you have a mortgage where the interest rate you have to pay on it is influenced by the central bank's interest rate. Obviously, an increase in interest rate by the central bank will automatically mean more payment on your mortgage. If you're spending way more than you should or had planned on your mortgage, it means lesser spending on other things. Now that you have lesser money, you will spend less, right? And if you don't spend much, or say a considerable number of people start spending less, it causes a big reduction in demand, and this will affect business. But this scenario is for people living in countries like Australia. In America or Canada, there are usually fixed rates for bigger mortgages. So mortgage owners with fixed mortgages are not directly affected by the rise in interest rates from the central bank. Indirectly, the increased interest rate will get to them. Because, since higher interest rate means more expensive mortgages, and since this will affect all new buyers, it will cause house prices to fall. This will cause homeowners to feel poorer, making them spend less. And lower spending creates a chain reaction that leads to a reduction in inflation, as we've seen. And this rise in interest rate will not affect the everyday consumer alone. It will also affect business owners. You see, when interest rates rise, business owners will find it hard to seek loans from banks that will be used for investing in their businesses since it is more expensive. That will lead to less economic activity. This means lesser jobs created, which means lesser job opportunities, even at low wages. If wages are low, households do not get much coming in. They will have to be frugal in their spending. So it's pretty much straightforward. The central bank increases the interest rate, which eventually affects the consumer and even businesses. It in turn reduces spending and business investments, which together results in a decline in economic activity. Because of that, businesses will be forced to stop raising their prices, and in some cases even reduce their prices, like we've said, to create and increase demand. In the end, inflation suffers and goes down the slope. And see, while this is a good strategy, it works to the economy's benefit as long as there is a measure of just how high these interest rates rise to. There is a point the rise gets to where it will lead to more pain than good, and the economy utterly suffers. For instance, in 1981, when America's central bank, the Federal Reserve, raised its interest rate to 19% in an attempt to fight inflation. And while it did beat inflation, it brought on more economic problems. According to reports, it brought on the worst economic mess in that time since the Great Depression. This is the reason this method has to be strategically employed, because it is really hard to curb inflation without it negatively affecting economic activity in the long run. No one knows for sure if this move by America's central bank will yield the desired effect. Economists are still watching to see how all of this will turn out. The reality at the moment is that while Feds continue to carry out their plan to control inflation, consumers and businesses will find it more expensive than before to borrow money from banks, and will have to endure a lot of repercussions caused by the interest rates increase.